Hi, everybody. It's really good to see you here. Welcome to this webinar. We're going to talk about some really exciting stuff, especially why the timing is really, really good to start a fund. But before we do that, thought I'd introduce myself. My name is Mike Supervici. I'm the head of acceleration here at Desol Group. For those of you that are not familiar with our company, Desol Group's entire sort of purpose of existence is to help new and emerging managers thrive. Okay, and we do that in a number of different ways. We do that through training. This session is going to be primarily focused on our VC Lab Accelerator. That's one of our 4 training programs. We also train, associates. We train limited partners. We train emerging managers that are on Fund 2 and 3. That's sort of our training component of our business. We do this through tools. We have a product called Desol Hub. It's become effectively the ERP for venture capital firms. About 1,000 venture capital firms use it, as well as our back office administration. And then we also have an entire capital network, and fund of funds to sort of reduce the friction with regards to fundraising, right? So if you just want to think about Desol Group, we're systematically trying to reduce the barriers of entry to this asset class, and our whole mission is to sort of democratize this and make this easier for everybody. So that's what we do. If this is your first time joining us on a webinar like this, you can introduce yourself in the chat. You can go ahead and say hello, all that. Just really quick though, before you do that, this is a public webinar, right? So you do not want to say, hey, my name is Josh, and I'm raising a fund that's doing XYZ. That's called general solicitation, and that's illegal, all right? And in certain places in the world, you can go to jail for this, okay? So don't do that. Just be like, hey, my name is Josh. Here's my LinkedIn, right? You can do that. You can put that in the chat, no problem. We like to make these very sort of interactive. Some of you are going to have questions, about whether it's the stuff I'm going to talk about or any questions that sort of come up. There's a Q&A button at the bottom of your screen. It looks like a little question mark. You can put questions in there, and I'm happy to take a look at them. You can also upvote those questions, and so that allows me to focus on the questions that matter, right? So that's basically what this is all about. The other thing I'm going to say, just kind of final thing before I wrap up and start talking about kind of the topic of the day. I'm going to spend roughly 20 minutes or so, maybe 30 minutes, just talking about some of the trends I see and why venture, it makes a lot of sense, and why this is a good time to start a fund and things like this. Once we're done with the entire presentation, we'll have roughly 20 to 30 minutes for you to ask me anything that's on your mind. Okay, so make sure you get your questions prepped. What ends up happening on a lot of these webinars that we do is that I kind of get blasted in the last 10 minutes, and I'm not able to answer everybody's questions. So just get them in earlier. That makes it a little bit easier for me to get everyone's questions answered. All right. So, all right, let's go ahead and get going, and let's talk about why now is a really good time to start a venture capital fund. So first of all, for those of you that don't know, at this point in time, roughly 60 to 70% of all new firms that are being started through VC Lab, our accelerator for powering venture capital firms. So this comes from a lot of experience, a lot of data, and a lot of trend lines. And when there was, some of you probably saw this on Twitter and LinkedIn, when there was a ton of doom and gloom, about oh, venture is like this, it's bad, or whatever. Our data was showing the exact opposite. And it's only now that you're starting to see some of the other kind of data sources coming. It's no, it's actually not as bad as it seemed, that kind of thing, right? But it's been like this for a while. So we've been seeing this trend really for the entire sort of year, that there's been kind of a renaissance in sort of capital deployment. A lot of VC firms are being started. And we saw, for us, even July was a record month in terms of sort of fund launches and things like this. And again, just if you sort of think of us sort of the market, especially for emerging managers, things are actually looking pretty good. So that's why we decided to do this webinar. We thought it would be helpful to kind of share with you all what we see. And then, of course, turn it into sort of an AMA and answer your questions. All right. So let's talk about why we think this is a really good time to start a fund. So the first thing that's happening is that obviously, AI is this big buzzword, blah, 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 but it's creating It's changing like everything about everything we do. Okay, it's changing the way people work, right? It's changing the way innovate. And this is not like just in pure tech, not pure Silicon Valley, right? Like biotech companies are using AI differently, right? Legacy businesses are using AI differently, right? And as a result of that, there's just been like a tremendous amount of innovation that's being started. And that's also affecting everything. It's affecting fintech. It's affecting companies like ours, for example, all of our tools, which then make it easier for people to get going, in our case, with starting funds and stuff like that. And so this has created a lot of opportunity. Okay. And when there's changes, and in this case, almost like tectonic changes, when sort of markets shift and opportunities change, that is usually when venture has a ton of potential, right? And so you see, we saw moments like this, right? Obviously, with mobile is another example of these kinds of things, but AI is probably even bigger. So that what has happened is that a lot of capital is going into AI. A lot of funds are being started to go after this opportunity. And because it's happening in every sort of corner of the world and in every sort of industry, there's a lot of opportunity for venture capitalists, obviously, right? So that's one. The second thing is we're seeing a little bit of an economic rebound and a liquidity surge. So what does that mean? There's a lot of uncertainty in Q1 and even a lot of Q2, right? But now things are a little bit more certain, right? The markets kind of have sort of stabilized and arguably have gone up a little bit. There's been a lot more certainty around various forms of legislation. And this is not just a US thing, and also for everybody. I know that we're a US company, but 60% of the VC funds that we launch are outside the United States. So we have like exposure across the entire world on a lot of this stuff. So there's just been like a lot more sort of stabilization on many fronts. It's not like that everywhere because the world's a big place, but for the most part, we've seen this. And then there's more. We're starting to see signs of liquidity, right? Figma's IPO is a really good example of that. A lot of people that invested in Figma's seed round, even if it was like $10,000 or whatever, they made an enormous amount of capital as a result of this IPO. And so that's good because all of that money is coming back, right? It's coming back to LPs. And because there's like a liquidity surge, a lot of these LPs are just putting it right back into the asset class. Okay. And so that's a really good thing in general. And so that's also contributing to this situation as well. The third thing that has happened has been that there's been a pretty significant market bifurcation in venture. So, historically, venture capital was like one thing, like one asset class. And now it's basically two. On one hand, you have very established venture capital firms that are very large. Think like Andreessen Horowitz, those kinds of folks. And they have very large funds. They manage a lot of money. They have a very different sort of like risk return profile. And on the other side, it's almost like a barbell. On the other side of the barbell, you have what are called like small funds, emerging managers. And, we're on track to see tens of thousands of these funds, right? And basically what has happened is that to invest early, pre-seed and seed in particular, it's really hard for the very large players to do that well, because you just got to see a lot of deals. It's a very different thing. You got to put a lot more capital to work for just the funds to sort of make sense and all that other thing, right? So it's just hard. And so new and emerging managers with very small fund sizes are sort of seizing the day and have taken advantage of this. And when you're sort of investing at that level and at that time and things like this, like seed and pre-seed, the managers that are able to win and get into the best deals are very specialized, right? They become more specialized. They're much more niche. It's very hard to be a super generalist, like pre-seed, like investor where you invest in everything, right? Because then you have like no edge, And so whether it's specialized in like a specific founder archetype, whether it's specialized in a a specific network, whether it's specialized in a certain type of company, like you're seeing a lot of niche strategies. I mean, pretty much like almost, I don't know the exact number, but the vast majority of the funds, for example, coming out of VC Lab, all of them have pretty much niche strategies. And that gives them an edge that allows them to overperform, that allows them to talk to the right founders and things like this. And this is really great. And because of that, right, there's like this sort of healthy ecosystem now, right, where you've got like pre-seed and seed primarily happening for this other part of venture, and then you've got like the bigger funds sort of dealing with all the rest of the the market. And this has also spawned this whole concept of like the more backing for these emerging managers through various emerging manager programs. We have Decile Group has a fund of funds, right? To back, we have a capital network to back funds. That's part of the value of what we do. But this is also happening with the funds on the other side of the barbell, the big ones, right? So a lot of the funds that are very big, they realize they're like, hey, we can't invest at pre-seed and seed because we can't see 1,000 companies that are effectively idea stage. And we don't have the type of coverage to be able to manage that. So why don't we instead create our own fund of funds program where we back these emerging managers that are going after these markets, and then we sort of, through their updates and events, everything, we see everything that's about to sort of bubble to the top, and we have an opportunity to come in and maybe lead the Series A, right? Or lead a very large seed round, right? So it becomes sort of this very like collaborative way to kind of make it happen, right? And so now there's more specialized types of capital that's becoming more available to this new and emerging managers, right? And so that's also really helpful from that perspective. So that's the other thing that's happening. The other thing that's happening that's also spawning a lot of this is just a lot of like these accelerated fund launches that are happening, for example, through VC Lab primarily. Typically, outside of VC Lab, it takes a fund 12 to 18 months to do a closing, like their first close, they have money and then kind of deploy. The average time for a manager to do what's called the first close that's going through VC Lab is 4.9 months right now. So basically think of it like 5 months. And it's like from like idea, right, to like full on money in the bank and I'm investing in startups. And the reason that this is happening is because like we're on cohort 19, right? This is, cohort 19 is launched. So we've done this 18 times over the last, 3 years. And we've seen like everything that can possibly go wrong. So we basically package things at the right time, avoid the classic mistakes so that people can get to market much faster, right? And as a result of that, you're just seeing much more faster launches of funds just because of like pure optimization and strategy and things like that, right? And so that is also making it a lot easier to do that, right? And so that's another example of why this is happening. The other thing that we've launched recently that's made this even better and even faster is that we've basically launched what's called the Start Fund, which enables folks to basically get started right away. So for those of you that don't know, it typically takes, roughly about 3 months in Delaware. Outside of Delaware, it takes a lot longer to set up a fund. In Singapore, it takes like a year, right? Because you got to get the proper licenses and it's like a lot of work and stuff. So we've been able to basically bring this down to a day. And so we've completely reinvented what it takes to basically start and launch a fund, right? So the reason that we've been able to do this is because typically, you need to set up multiple entities, got all these filings and everything like this. We're able to package this down into like one entity into the Start Fund. And that reduced the cost by 3x. We made everything super automated, which allowed everything to kind of get going right away. And like the old adage used to be, right? It's like, hey, pick two, fast, cheap, and good. We've been able to sort of kind of make it all work, right? Where you got fast, cheap, and good also sort of working. which is, and again, helping more and more funds get started right away. So, a start fund gets set up in a day, right? You just got to pass KYC and ML, we set everything up, and you can literally close LPs like the next day, versus kind of setting everything up, hoping you get the commitments, getting all this done. And, that really helped. It also reduced all the costs. Typically, you have these enormous costs to set things up, right? Law firms charge $100,000 to generally form a fund, sometimes more, right? And that's just the legal part. There's also the admin, audit, and all this other stuff, right? And again, what I'm showing here is in Delaware. For those of you that are not in the United States, you got to like double or triple these costs, okay? Just because of the providers are much more expensive, right? And so we made it super cheap, right? And then the third thing is that it's like an official fund one. Typically, like a lot of these products that were kind of built this way, you had like no ownership or anything like this. With this, you can move it under your own Manco. LP see it as a classic like fund one that allows you to build track record. You got professional IC support. So anyway, the whole point of this is to say, hey, this has allowed people to launch funds at a significantly faster and lower pace, because you got the education, you got all the tools, you got, again, a lot of capital coming in. And now that has opened up a whole new market, because with start funds now you can take limited partners that are very small, like $10,000. With the traditional fund, you just can't do that because you're losing money, right? In a traditional fund, you need 100,000 plus, right? And so there's, both work, both are good, but before, you needed to raise 10 million to justify this. Now you can raise 500K, right? And so that's another way we sort of brought this whole cost down. And that allowed, again, this is another thing that we've kind of learned just from the VC Lab program and doing that. So, you can build your track record like right away, right? And this is not just with the start fund, but everything that we're talking about here. So I've talked a lot, about why and how everything's happening. What I want to do now is go into your questions about the market, about things that are happening. I see that there's a lot of commentary coming into the chat. Again, for the people that joined late, go into the Q&A, put questions into the Q&A, right? So there's like a little question mark there, and I can go ahead and answer that. While I do that, cohort 19 applications, they're live now. Okay, make sure that you apply. We look at every application. We typically get roughly about 3,000 or so applications. And so if you are thinking about doing this, for your sake, we recommend that you apply sooner than later. And the reason for that is because we end up getting blitzed with roughly 1,000 plus applications at the end of the period. And it's just harder for us to kind of get done, through these applications quicker, right? The program's completely free. Everything, whether it's like Start Fund, whatever, these are all like sort of application only programs, right? That are sort of available for people. They may not be for everyone as well, and that's cool, right? But the program is 100% free. We'll help you get a fund launched right off the ground, so you can go ahead and let us know. All right, right on. I see a lot more things are coming into the Q&A. Feel free to upvote the ones that are important. So like there's like a little button like this. Go ahead and hit that. And then you can go ahead, and then I can go ahead and prioritize. Could you please provide detailed breakdown of the cost structure of a fund? That's like a super hard question to answer, Roberto, okay? Because it depends on where you're doing this, okay? So let's take a step back, okay? In general, if you're gonna build a fund, you're not gonna build a fund, you're gonna build a firm, a VC firm, okay? So this doesn't make sense for anyone to do unless you're gonna do a start fund, unless you're gonna build a firm, because you're not gonna make enough money off of management fees to just manage one fund. Okay, so you need to have multiple funds under management. So in order for you to have multiple funds under management, you need a firm. Okay, so you need to typically set up 3 entities: management company, general partnership, and LP entity, right? Each of those entities are going to have fees, right? Depending on where you are in the world, right? Taxes, right? So you've got that. Then you've got administration costs, which are typically on a yearly basis, and they vary almost the whole world outside of kind of what we're trying to do here is varied, right? So it's really hard to budget, okay? And then you have compliance, KYC, AML, all those different things, right? Then you have audit, right, for in a lot of cases. And then you have all the legal costs that I sort of talked about there, right? So you've got all those things generally coming together, and that's what typically happens. Now, a lot of people are like, oh my God, that's like a lot of stuff. You don't pay for any of that stuff. Okay, like nobody pay, like these are all what are called fund expenses, and we can put that into the chat for everybody. So in other words, the fund, the LPs pay for it. But in order for you to be able, for the fund to be able to afford paying for all these costs, it needs to be a certain size for it to make sense. And right, and so this is why we had to build out the start fund structure, right? Is to allow people to build smaller funds, because you do not want to take half of your LP's money and put it into like operations, right? That's bad. That's bad for everybody. So hopefully that answers your question on that. Go ahead and go to the fund expense doc that was put in the chat if you want to learn more about that. In other types of investing, trend spotting and trend following are tried and true strategies. How important are these techniques for VC investing? For instance, is it more important to stick to your niche specialist strategy or to adapt to emerging opportunities? The way you want to think about venture is that venture is a very like outlier business. The difference between a great VC and a good VC versus like the difference between a good public equities investor and a great one is exponentially higher, right? So for example, like the public equities person maybe is 2 to 3x better, right, than a person that's like good. In venture is like 100 times. And what drives these sort of 100-time outcomes and how you end up getting 10x, 100x funds is by being able to spot sort of outliers. So I'm not sure if you saw this, but there's a company called Ramp. They just raised another 500 million at a 22 billion valuation. Their pre-seed round was at a 30 million valuation, right? So if you put in like $10,000 at that point, that $10,000 is worth roughly 7 million. You know, roughly, it's, you know, like there's probably something, that's if the company goes public and all that, but that's, you know, that's the example of sort of an outlier. And you're going to have a portfolio where you're going to make like 25 bets, you know, maybe 50 bets. And most are going to go to zero, you know, but, you know, if you can get 1 or 2 or 3 ramps or something in your portfolio, that's how the fund ends up being 10, 100x, whatever, right? And so it's more about like, you know, adjusting to sort of like the market and trying to figure out exactly what makes sense for you. So, you know, in venture, there's effectively like kind of 4 ways to make money, right? So one is you just are a really good fundraiser and you can get a bunch of AUM, kind of like what you're seeing with Andreessen, right? Like if you're that good, and I don't think anyone on this call, obviously if you're there, you wouldn't be on this call, but if you can raise billions of dollars, you're going to make a lot of money in fees, right? It's just the way to do it. Another way to do it is you can get founders to give you really preferential like terms. So YC is a good example of this, right? They're able to sort of kind of get like kind of preferential terms because of all the value that they're providing, okay? The third is to just invest really early. Kind of what I was talking about a little bit earlier, like pre-seed and seed, you know, like that kind of stuff. It's very early before it's obvious, you know, and that's kind of where most of venture is kind of going, at least emerging managers. And then the fourth one is to invest in stuff that like nobody else understands or sees, right? So I don't know, overlooked founders, like legacy stuff, like those kinds of things that like a lot of VCs generally don't invest in as much in, right? Like, and if you can get in and one of those companies sort of breaks out, right? Like that is another way to make money. And in order for you to sort of execute on like the last 2 strategies that I've discussed, you kind of need to have an edge, okay? Like there's got to be something about you that allows you to execute on those strategies, which is what creates sort of like this niche, which is what I was sort of talking about. Right. And so you kind of need like you need some level of, and I use this in quotes, like specialization, but it doesn't need to be like, hey, I just do biotech or something. It needs to be like some sort of an edge that you have that allows you to pick these kinds of companies. And then you end up building a brand around this sort of edge, right? And then you end up getting the type of deal flow that gives you higher shots on goal for that. And if you can sort of spot trends before they become big, you end up doing really well. So that's a kind of like a long-winded answer on this, but hopefully that gives everybody a little bit of context on kind of how to think about venture in general. How is the fee structure for launching funds with VC Lab? Mahan, VC Lab is free, right? There's no like catch here. Like, this isn't freemium. Like, we're not like trying to upgrade people like later in the program. We just provide an enormous amount of value that gives you a lot of opportunity to figure out if you want to work with us and whether we want to work with you. And then everybody that has a mutual interest in working with us, whether it's in our back office, whether it's in our tools, whether it's with our fund of funds, goes through an application process, right? And then we can sort of figure out if that makes sense. And so, that's it, right? That's the thing. But the VC Lab, it's completely free. It's designed to be free. We want to provide a lot of value because right now the entire venture ecosystem is super broken. There's a lot of bad behavior. This is why everybody that goes into the program has to share the Mensarius Oath publicly, because a lot of people do bad things. And we want to fix the whole asset class. And by doing so and providing an enormous amount of value, a lot of people just want to work with us. This is why, 1,000 firms use our software. That's why over 150 firms use our back office administration, and so on. But that's, again, a decision you can make a lot later. And that's it, right? And so VC Lab as a program is completely free. And then everything else is within market. So for example, like if you want to use us for like fund administration, is like basically like the same or less than pretty much anyone out there. I don't know, and that of course, depends on your strategy, like what you're trying to do. But I'm happy to go into it a little bit more detail if you have more questions on some of this stuff. What is the average fund size for the 9-month timeline? I don't know, typical fund size in VC Lab is I think like 12 million right now, but that doesn't tell you anything, literally, because I have no idea where you are in the world. If you're in a place where venture is a newer thing and like an emerging market, the fund sizes are going to be smaller. They should be smaller. If you're in a place where it's more developed, maybe the fund sizes are bigger. And in VC Lab, we try to drive everybody's fund size down. Okay. And so, a lot of people come in with very unrealistic expectations over how much money they can raise. And, you cannot ever afford to be undersubscribed, because if you end up undersubscribed in fund one, you will have a really hard time raising fund two, because every LP is going to say, hey, fundraising risk, right? And so we try to set these targets very small, but typically on average, like when I think about like what's actually been closed, roughly about 12 million for a fund one, but small is great. $1 million fund one is great too. It depends on kind of what your strategy is. Is Start Fund only available for the US LPs to invest in US registered companies? No. And actually, if you go to Dominica, maybe you can put this in here on the Start Fund. We actually have an entire FAQ on this. There are certain areas in the world where we can't take LPs and we can't make investments, right? Because the regulatory environment is just so stringent. So for example, Europe, right? Europe has really difficult marketing rules right now. So can't take LPs in there. India, it's super hard to get money in and out of India, and it has nothing to do with Start Fund. It has nothing to do with any vehicle outside. It's just that the local regs make it incredibly difficult due to the repatriation. So we can't really support that. We don't want to be involved in that, and we don't want to be like responsible for, sending checks back to your LPs that are half what they were expecting or more, 75% what they're expecting, because of like a whole bunch of taxes were withheld back in India, right? And so we list all the countries that are we can't work in, but as a general philosophy, yes, we have a lot of international funds already in Start Funds. We have a lot of international LPs. Okay. As an emerging manager, will we be able to give ourselves our salary through management fees with Star Fund, or are we expected to keep income sources outside of the fund? Yeah, no, you get management fees with Start Fund for sure. That's actually why we did it this way. And what's really neat in Start Fund, and again, this is from lots of experience of managing traditional funds, you all are not going to make a lot of money, right? There's just not a lot of money in fees. Even if you're like able to pull down 10 million, which is very hard, that's not that much money because you got to run your entire business off that. It's not like you get, 2 and 20, 200K a year. It's not like it's your salary. That's like your operating budget for your business for like a year, right? It's like, it's very, so you don't make a lot of money even in a 10 million. What we did with Start Fund though is that we basically moved all the management fees to the first 2 years. So instead of you taking them over 10 years, you get them in the first 2 years, right? And so that you have a little bit more to sort of work with. And then that allows you to get to fund two very, very quickly. And then in fund two, maybe you raise a bigger fund and then you have more management fees now and you can build a business. All right. Can you participate in more than one cohort to learn the various perspectives that a fund managers go through? LP cohort, VC cohort. Yeah, you can, but let's be very clear about this because I think this is important. VC Lab is not a learning program. All right, it's a closing program. You're going to close on LPs. You're going to be expected to close on LPs. You're going to be expected to have commitments. Within like, let's call it the first month of starting the program. Because if you can't get commitments for your fund within that fast, you're just going to struggle to raise more money in general, and you're going to be out in market for like 3 years or whatever. So, and then that validates if your thesis is correct. So you're going to be pitching LPs. So these aren't like learning programs. Even our programs for LPs, they're not learning programs. You're expected to invest in the fund at the end of the program. Like these are like all very sort of tactical programs. The only program that we have that's more like learning, it's called Venture Institute, where we train associates and we place those associates in funds that we power. Because yeah, they need more training there, right? To be able to help the fund be as successful as possible. And since we're in the business of helping funds be really successful at what they do, we want to put in the right people to help them kind of get to the next step. But these aren't learning programs as a general rule. These are like, I'm going to go and close a fund. And if you're going to close a fund, that's like a full-time job, right? Like you might be able to get away with part-time in the first part of it, but it's going to be full-time by the time you finish closing it. How do you know if you're ready for VC Lab? I want to start a social venture studio, but I need at least one partner to help planning and implementation. Well, I think the way you know that you're ready for VC Lab is by looking at your network, and it's something we actually also do in the application process. Like if you don't have a very large, strong network, you're going to struggle to have good deal flow, and you're going to struggle to find investors for your fund because the LPs that are going to come into your fund are, especially if it's a fund one, are going to be people that right? Like it might not be like your best friend or family or something, but there's going to be people that you've worked with and they've known, they trust you, right? That it's pretty risky to invest in a fund one with a manager that hasn't done this before. So the idea that you're going to get like money that doesn't know this, that's going to put money in just randomly, it's pretty low. Of course, there's sources like Basel Capital, right, where we kind of specialize in this kind of thing, but as a general philosophy, like no, right? And so if you are kind of swimming in deal flow right now, right, and and you can tell that there's a lot of like kind of high net worth individuals in your sort of circles, and that this is what you kind of want to experiment with or want to try to do, then go into VC Lab, right? Because VC Lab is going to help you figure it out very quick. We're going to, like I said, you're going to, as part of the program, you're going to like have this thesis, you're going to go out, you're going to start talking to LPs, and you'll see if they buy or not, right? You're going to get commitments in the first month. And if you can't get commitments in the first month, they're like, well, maybe this is not the right time, and you can come back in the future, in a future cohort, no problem. It's a free program. You can drop out and come back whenever you're ready. Do you hear objections from potential LPs on the start fund structure? Not really. I mean, again, I think that, start fund makes a lot of sense for the kinds of LPs that typically back new managers, which are primarily high net worth individuals, and not only are we're not getting objections, they actually have a lot of comfort in the start fund structure because there's an IC component of this. So they just know that the probability that the manager is going to invest in a fraudulent company is super low because the IC looks at all that stuff, right? So it's much better for them. Second, it takes out what's called like the key individual risk. So for those of you that don't understand what this is, there's a concept in every sort of limited partner agreement of like a key individual that runs the fund, right? And that person is responsible for everything. So a lot of times when you are doing a solo GP fund, if something were to happen, right, you might get sick or even worse or whatever. That is a risk, right? And in this case, with the start fund structure, there's none of that risk because Dessau Group comes in and fills in that gap. So there's just like a lot more safety for that, where I would say that you want to start thinking about a traditional fund over a start fund. So for example, like what we do in like our Dessau Partners offering is when you're sort of in that 5 to 15 million range and you're getting very large family offices and institutional LPs committed and they want to do like capital calls and they want to have like specialized terms and things like this, that's when you need a little bit more of a bespoke solution versus a product like Start Fund. But for pretty much most people that are starting funds, it's going to be primarily high net worth individuals, very small family offices. So they're not going to be very like sensitive to a lot of these things. All right. I have a $5 million fund. I'm almost done deploying. I'm still learning. Can I launch my second fund with VC Lab? Yes. And as a matter of fact, Milan, we have a program specifically for you called the Emerging Institute. So this is for people that are on Fund 2, which is a very different strategy on how to raise that now that you already have a Fund 1. And as part of that, we sort of get you ready for that next level of limited partner, which tends to be more institutional in nature. So we help you get ready. We feature a whole bunch of institutional LPs. They're coming in, training you as well. If there's mistakes that were made in Fund 1, we help you clean those up and things like this so that you can actually pass diligence in Fund 2. So it's called the Emerging Institute and it's specifically made for people just like you. All right. Is the power law still relevant or are VCs more picky? Power law is still super relevant for sure. For sure, very relevant. But the cool thing is that if you're doing like a small fund, if you play this right, it's just the multiple on the fund is significant. The other cool thing that happens with small funds is that you have more opportunities for liquidity, right? Like you could actually take a secondary on, case in point, back to this ramp example, you can take a secondary on the ramp deal in this like round at 22 billion, so you don't have to wait till the IPO, and that would have probably multiplied your fund by X number just by itself, right? And so you have more potential, but in order to do that, you do have to get into a ramp, right? Which is worth $22 billion. So look, venture still that, right? Because most of your companies are going to go to zero RS, right? Like that's just there's and if they're not going to zero, right? And you have a bunch that are sort of just kind of throwing cash flow, the multiple on those are not going to be that high, right? So it's almost like a zero. So you are trying to back these companies that are going to become very important in the future. That's why venture is. If that's not kind of your thing, then maybe venture is just not the right product for that. And that's okay too, right? There's like other things, revenue financing. I'm not trying to claim that this is better than that, but like venture is a very outlier driven business. Okay. You're going to make 20 to 50 investments with your fund. And really only 2 or 3 of those are going to be responsible for the vast majority of returns in your fund. You're not going to get like a bunch of 2Xs and that's how you get to a 2X fund. Okay. All right. Could you still raise a fund with VC Lab without going through the program? Yeah. So, if you want to work with us in, with like a start fund, for example, Michaela, or if you want to build a traditional fund structure, we can look at that, like we still go through an application process there because we want to make sure it's you just want to make sure that it's the right fit for both sides, and also that we can actually support you, and so you want to go through a process. So you can go to our website, and maybe you can put our website in as well. And on our website, you can actually fill in a quick application there, and then that's how we'll start the process, and we'll get on a call with you and ask you some more questions. But as a general rule, the way you want to think about our business, we're trying to make sure that it's decile group, top 10%, right? We're in the business of helping people become top decile. Okay. And we want to help you as much as possible. But if we're going to go all in and help you, like, we want to make sure that there's a lot of alignment there. First, that you want to be helped. Some people just don't want to be helped. They're like, they don't need that help. Okay. Well, maybe we're not a good fit. Second, we want to make sure that you're thinking about this from the highest ethical standard. There's so much unethical behavior that happens in private funds. Case in point, Bernie Madoff, right? It's so easy to commit fraud in a private fund, and it's usually innocent. It's not like because the person was a bad person. It's just they did something they didn't think about, right? And so we want to make sure that we're working with only the highest ethical standard, because we want to, the next generation of VCs to be super ethical, right? As a philosophy, right? So that's super important. And third, we want to make sure that, the way you're thinking about your approach is something that we can actually not only support, but get behind on, right? Like, I always think like, hey, if I'm going to go ahead and actually empower your fund and do fund administration, is this a fund that I would be comfortable featuring in our LP marketplace? Because like, that's a lot of responsibility. Like, if an LP comes into your fund and that becomes a bad experience for them, that's really hard, right? And I want to be able to sleep at night. You know what I mean? Like, so like, I think about all those things, and the whole company thinks about all those things. So those are I just want to create a win-win, right? And so that's why we go through this process. We're not, trying to just work with everybody. We just want to work with the best, basically. All right. When someone launches a fund on Carta, there is a lot of yearly expenses for 10 years on Carta on Angels 10 years. Is there some data points on expenses associated with VC lab funds versus other platforms? Those fees are going to be like basically like the same ish on any platform for the most part, unless you're working on a start fund loan, and it has nothing to do with AngelList and Carta. Okay. And as a matter of fact, Carta is not a good fit for most people because they make a lot of mistakes, and I don't recommend them at all. And so I would not do that. And they're also moving away from emerging managers. So if you're on Carta, that's not a good thing. But as a general philosophy, if you're doing fund administration, Milan, right? Like, there's people that have to do that stuff, right? And so there's a fixed cost to that, right? And you're not going to be able to fully automate this whole process, because there's a lot of things that happen. Like, for example, if you use your own law firm, they probably built some weird stuff in your docs, and all of a sudden the fund admin has to deal with all of those things, and that could be very expensive. This is why all these SPV businesses, by the way, have failed historically, and most are probably going to fail, right? Because there's all this custom work, and you have to manage this for a long time, and there's all this complexity, right? And so most of them are that. But again, those aren't fees that you pay. They're paid by the fund. And the key thing there is that your LPs want you to use a reputable platform so that they can get things, and are willing to pay for that, right? So they can get good reports. Where you end up having problems, particularly with the people you've mentioned here, is that you're paying a lot of money for this stuff, and usually you're getting bad outcomes. Because what happens, right? You just told me about your fund, very small, right? Very small. Okay, so what's going to happen when you go to like a Carta or whatever, right? You're going to get like the most junior accountant ever, so that they can save costs. And it's like the blind leading the blind. New GP that has no idea what they're doing, new accountant doesn't know what they're doing, right? And that's how mistakes happen, and that's how all these funds end up getting out of compliance. And compliance doesn't come as with a lot of these things as well, right? So that becomes a huge problem. So what we're trying to solve is we're trying to basically give you what we call like an institutional grade platform and operation so that you can pass diligence with like a massive LP because you have all your ducks in a row, along with business advice. It's like, hey, don't do that, because if you do that, it's going to affect you like this, right? Which is, again, why we work through sort of like a application process, because if you're not sort of receptive to that, then a lot of our model doesn't work either. Okay, how do we make money? I kind of talked about that. So, we have SaaS, right? We have fund administration, we have fund of funds, right? So those are all ways we can make money, and we make money, and it's a very good business. So that's it. Those are it. And there's more opportunities to make money in various other products later. That's the idea. Okay. What is the percentage of getting a fund for SCA country? Previously, how many projects getting fund from SCA country? I'm not really sure what this question means, Sid, so you're going to have to redo this one. Okay. What's your experience with funds in developing economies in West Africa? Right now, roughly half to 60% of all funds on the African continent are launched through VC Lab. We power a number of funds. We have funds focused on, both sides of the continent, both West and East, right? Yeah. So I don't know, I don't know how else to kind of talk about this, but we have a lot of experience working in Africa. What I would say the biggest issue there is more like the LP base. I think that's where you end up having most of your problems, because some LPs are not as familiar, so you end up having to do a lot more education, if that makes sense. In the UK, there's an incentive to establish a channel, Canary Islands, Bermuda fund, et cetera. Does the location of the fund make a difference for credibility, compliance, DE versus DR, for instance? Super good question, Colleen. As a general rule, those kinds of places are a complete ripoff, okay? And the reason that they're a ripoff is because, and this is not just there, like Cayman is another one, BVI. The reason for that is because those entire places, like economy, is that it's like fund domiciliation and that, right? And so basically, it's like it becomes very corrupt very fast. Like, you got to use this vendor, you got to do this. They're small. There's not a lot of competition, right? The reason that Delaware funds are so much cheaper than pretty much everywhere else in the world is because they're just like a much bigger market of fund formation lawyers that, for example, know what they're doing. There's a much bigger market of administration providers that know what they're doing, right? And so you just have much of that, right? In those places, you just don't have that. And so they end up being excruciatingly expensive, and it's like death by 1,000 cuts, because you have all these extra filings and fees and da-da-da-da-da. And so as a general philosophy, not great, okay, for like putting your fund there, okay? The UK on a whole is a whole different issue. The UK, because of Brexit and all that, it used to be one of the places that was like kind of a worldwide hub for fund domiciliation. It no longer is. And what most of the UK funds are actually doing, they're putting their funds in Delaware, and that's how they're dealing with it. That gives them access also to the best startups, because a lot of the best startups in the UK end up either redomiciling or putting a holdco in Delaware, which then allows them to access the US market, which is much bigger, right? So it actually creates a lot easier of a situation. It's not always 100%, Colleen. Like, for example, if all of your LPs are in the UK and all the startups that you're backing are in the UK, I can see a pathway to you doing a fund in the UK. Just know that it's going to be a lot more time consuming, a lot more expensive, just in general, right? And so that's the only like kind of downside, but it does make sense. Like I said, if every one of the LPs is in the UK and every startup that you're going after is in the UK. if you do a start fund through Desol Group, what is the process of spinning out your own VC firm once you're ready for fund two? Start fund was designed specifically for this purpose. And so if you end up working, with Desol Group, what we do is we set up the traditional structure. So for everybody back, if you missed the first part, I talked about this. There's 3 entities that happen: Manco, GPLP, and we move the start fund under your Manco, right? That's why it's a proper fund one. And that's why it's really hard for, like, if you were to use a product like this on AngelList for LPs to think of that as like a fund one, and so this is a proper fund one. It's really easy. If you don't end up working with us, let's say you end up like using your own law firm, using your own like providers and all that, that's fine too. There's no issue with that. But there's going to be an additional, obviously, cost, right? Because the law firm has to like make that transfer happen. Okay, but it's easy. It was built into the operating docs because, again, we're in the business of helping you build enduring venture capital firms. We want you to be in business for a long time, and the start fund is like a stepping stone to that, right? And so we wanted to make it portable, and it's one of the main features for it, right, on purpose to allow for this to happen. All right. In the end, do you recommend going through VC Lab, even if I don't have any potential investors in my close circle? We'll work with Connect with some and start to close on them, but I don't have any at the moment. Would it still be a good fit? Any recommendations? As a general rule, like most people that what I'll tell you is that you should just apply. The admissions team looks at your network and tries to figure out if you have enough in your enough in your pipeline to be able to pull this off, right? And then if you come into the program, we're going to test you out, right? You're going to like go out and get commitments. So you're going to figure out pretty fast if this is viable, like within 4 weeks, right? Because we don't want to waste your time and we don't want to waste our time, right? So the program is going to do a lot of this, help you with a lot of this. That being said, most people have a lot more network than they think. It's just a matter of like thinking creatively about it. That's the thing. When we say like close network, I'm not saying like your family. You might have worked in a company or something where there's a lot of, let's say, high net worth individuals. Like all the executives at a lot of big companies could be LPs in your fund. You might be around a group of angels or something because you're running an accelerator. You might have a bunch of mentors that are in your accelerator program. Like, so you can get like really creative about this. So most people have more than they think, right? And then once you get what it's called like the first close, which gives you a critical mass, and you're able to make some investments, now all of a sudden, you can talk about the investments you've made in the fund. That's where we've lowered the barriers of entries with the start fund, right? It's like now you can actually start a fund for like $150,000. Right? Like, I mean, if 150,000 is like, if you just think about that, and minimum ticket is like, for most VC funds, right, is starts at 150, typically is even higher, right? Now you can do a whole fund for that, right? It's a lot easier than ever because of the start fund, right? So I would start looking at your network and getting a little bit more precise about who's in it and what your relationships are. And then, maybe give it a shot. Can I draw salary when I'm using the start fund? Yes, you get management fees, John, with start fund. Absolutely. Which is why a start fund is better than SPVs, right? Like, I don't know if anybody on the call has done SPVs, but SPVs are kind of a pain in the butt, right? You have to like go out and like try to fundraise for these investments. Most of your deals cannot get SPV'd, right? Because they're so early that it's hard to build enough critical mass for people to come in and want to invest in some of these companies because they're so early. So, SPV was always a hack, to try to kind of help people get in business, but it's not really a good tool for investing in pre-seed and seed startups. It's better for like investing in OpenAI. That makes sense, right? Because that is something you can subscribe and get people in. And SPVs, you don't get management fees. And so it's just like an enormous amount of work. Most can't get subscribed, right? And so Start Fund fixes that, because you can raise all that capital into a blind pool, start deploying it. Now you have some portfolio, you can raise more money into it, start deploying that, right? And so then you can actually build some track record and build a VC fund. And pretty much everyone in our cohort that has done a lot of SPVs, like, was just like so tired of it and are so thankful that now they can actually have a real fund and they're actually doing fund investments, right? So that's lots of benefits there. Is the accelerator online? Yes, the entire program is fully online. You get 2 sessions. One is an Ask Me Anything with myself and my co-founder Adeo. Another one is a mentor session where we bring in typically an alumni or an investor or something like this. You get regular office hours. There's weekly sprints and deliverables. We're going to have more info sessions on the actual accelerator and all the ins and outs of it. But the bottom line is that think of it like a 3-month program that's going to help you get your fund closed. Yeah, so the Start Fund charges a 1% management fee, a 1% operations fee, covering all setup annual cost. Is that the typical 2% fee? What is the salary? Yeah. So basically, like 1 + 1 = 2, right? So the management fee goes to you, and then the operations fee goes to Desal Group to deal with everything for the rest of the fund life. And you get that entire fee in the first 2 years, which is really good for you, right? Because it's a lot more money that way. So the salary is your management fee. All right, cool. Well, okay, one more. Do you help new VCs learn how to ask their network to invest in the fund while still complying with general solicitation regulation? Absolutely. We do practice pitches with you. We have an entire AI that helps you write emails correctly that are compliant. We spent a lot of time on this in the program. I'm glad you brought this up, because general solicitation is a huge problem. So yes, we do that and we help you. And this is why, again, this is another reason why if you go through VC Lab, you end up closing in 4 to 5 months, whereas the average manager takes 12 to 18 months, because you're spending time on the right things at the right time, asking the right LP, because that's also part of this too, Ismail. Like, if you're pitching an LP that will never back a new manager, like, what's the point? You're wasting a lot of time. So finding the right LPs and then talking to them with the right message, which is what you're essentially asking me here. All of those things have to come together. And that's why it's so much more efficient to launch your fund through VC Lab. And that's why most get started this way, So absolutely. All right. Well, we've reached the top of the hour. Everyone, applications for cohort 19 are open right now. If you're thinking about applying, just do yourself a favor and do it sooner, because again, we get blitzed with like 1,000+ applications typically in the last week. So we get roughly 3,000 every quarter, every time we do this. So we want to make sure that, we have enough time to look at your stuff, look at your video and all that. So apply now if you can. Hopefully this is helpful. Hopefully you've learned a lot. Hopefully you learn about Desal Group as well as part of this, and looking forward to seeing you in a future one. We do these sessions basically every single week. So I'm hope to see you soon. Bye, everyone.